And we are live today on a special edition of Monday Livestream. It's usually Livestream Tuesday, but today we're going to call it Monday Livestream because, all right, let me put this away. Pretty amazing, right? Yeah, I mean, this Rubik's Cube with like these tiny little squares. Yeah, I mean, truthfully, I'm not very good at these things. My daughter used to be amazing, make incredible shapes out of it, but I don't know. I've got all of these kind of like these toys around of all kinds that I keep for entertainment and sometimes so that I can use them as YouTube props. All right. This week for Monday live stream special edition because, hey, I am leaving early morning tomorrow and flying off first to Dubai. I have like a long layover there uh, because of like when the flight arrives and when it leaves. And then I get to India on Thursday. And then I'm going to spend Mother's Day with my mom. And then I'm going to be there for 3 or 4 days. And then I'm going to fly right back. So that's the reason for Monday live stream. And in today's live stream, I want to talk about two secret stocks. All right. I mean, I wrote this long post on X, previously Twitter, and it got a lot of traction. I'm going to share it with you. Let me see how many did it's got 3,790 views. And I was like, okay, there's a lot of people here that are paying attention. I have said something that clearly is getting attention, that is resonating with, the most informed social media for sure. I mean, Reddit has a lot of pretty informed people, but I think the folks on X are the most up on things and is the best source today for financial information. There's a lot of garbage on there too, but if you have an understanding of things, X is the place to be. So today I want to talk about these two secret stocks. Now, okay, they're not so secret because I've given it away in the description, but I want to lay out what is happening, what I think is going to happen, and what the potential upside could be, which in my judgment, if things go right, this just could be huge. Now, I've been saying that for a lot of time, but that isn't the nature of these kinds of trades and speculations. Sometimes they happen like that. Sometimes it's like this and then, So, all right, before we get into all that, let me do all the legal stuff that I usually do, which is that this live stream, the content from ATG Digital Media is not investment or financial advice. It is presented to all of you as opinion, information, engagement, and entertainment. Whatever you choose to do with it, it is your responsibility because it's your money and that's your responsibility. All right. Next. All ATG digital content may contain errors, oversights, and mistakes. Understand that investment operations have significant risks that can lead to the loss of your principles. In other words, if you buy, sell stocks, options, crypto, you can lose money. And so you should think very carefully before you do anything. Next, the owners, employees, contractors, own, trade, transact, and securities are mentioned in this video and all content from ATG Digital Media. I want to add as well that we do not take money from issuers of securities. I know that this is a scandal that is unfolding in the newsletter industry, etc. But we do not take money, whether it be from crypto, stock, promoters, anything like that. No, we are completely independent. I do my own independent research. And right or wrong, it's all our own thinking. Next, if you want a list of all the free content we put out, there's a daily Substack, which is 100% free. There's a lot of people that charge for Substacks. We don't. And the whole goal is to introduce you to our way of thinking, our approach to the markets, our strategies, etc. Ballman Speculating. I actually just did a podcast and put it up last night on options, on folks that are selling options, big risk there that fewer people are thinking about. So if you're doing that, check out Ballman Speculating. It's on Spotify. Obviously, I'm on YouTube. And then social media, I mentioned X, where I'm very active, very, very active. And sometimes I write long pieces there because sometimes I just think of it and then I can cut and paste stuff and do things together. We're quite active on Facebook. While I'm away, if you want to follow my journey on Instagram, follow me on Instagram. And I'll be putting up pictures of my journey as I go visit my mom. I haven't seen her in 2 or 3 years. So this will be a reunion and over Mother's Day. So that's that. And with that, a quick plug for ATG Digital Media. If you want to subscribe, that's $9.99 a month, and we have subscriptions that go up from there. All right, shouldn't spoil the fun here. All right, let's get to the subject of today's live stream, which is that there is an impasse. For some people, it's a crisis. From some people, it's a problem in the real estate markets. And it goes as follows, like this, right? Which is that existing home sales have just completely cratered. I don't have a chart of this up, but if you Google for this, I mean, essentially existing home sales are, I believe, at the lowest levels in something like 15 years, maybe even 20 years. And the reason for it is as follows, which is that at current mortgage rates, which are approximately 7.5%, and current real estate prices, most buyers either don't want to engage or can't. In other words, they can't afford it, which means the high price and 7.5% mortgage rates. Yeah, their mortgage payments are too high. They can't afford it, or they're like, I don't want to pay such high prices and pay such high interest rates. Then on the seller side, those folks are like, well, hey, I have this mortgage, which I got in 2020 or 2021, or even a little bit earlier than that, which has like an interest rate of, I mean, at the very low, there are folks that actually have mortgages with 2.5% for 30 years. Yeah, 2.5%, or 3 or 4, or even 4.5 or 5%. I mean, I didn't get so lucky as to have one at 2.5%, but I do. I think my current house, my mortgage is like 4.25%. So very naturally, that's like a hurdle to overcome, which is like interest rates today are 7.5%. Housing prices since 2020 in many places have jumped by 50, 75, 100%. I've seen markets in which they've jumped even more than that. So folks don't want to sell. Folks don't want to buy, even though many people need or maybe want to sell, either because they want to downscale, empty nesters. On the flip side, there are folks that, they want a slightly bigger house. They're having families and they want to move. In other words, the existing home housing market is kind of locked up. All right, let me kind of go to my my post on X and go through it, where I lay out what is going on and why things are setting up for something to happen with the two secret stocks. I mean, we've been in Fannie Mae and Freddie Mac since 2018. That was when I first recommended Fannie Mae and Freddie Mac. Back then, it was really purely a speculation that, look, I mean, these are two dominant companies and they got to be set free at some point in time. I mean, there's no way that there's no history of like such large companies doing something so critical for the economy just being in this kind of purgatory forever. There's just no record of that. There's no company that has just persisted like under government ownership forever. But as time has passed, I mean, there's been catalysts that have come. Oh, court judgments maybe for a little while President Trump was in power. There was active movement to free these, and then President Biden was elected and things reversed. But there is something going on, folks. I have done a number of videos now over the last couple of years. And so today I want to go into this X post. Let me increase the size of this. I think that will make it better. Yeah, it makes it better. So I put up this X post and it lays out my thought process and my logic and for why something, in my judgment, and remember, this live stream is my opinion and my judgments, is about to happen because of Fannie Mae and Freddie Mac, because of the new politics around mortgage rates, right? And so you already know this, which is that mortgage rates bottomed out, at least when I look at a chart, at a bit under 3%. And then low rates have surged real estate prices and home buying. I mean, in 2020 and 2021, remember the frenzy to buy real estate? People wanted in because work from home was exploding. People were like, I don't want to live in cities, all these things that were going on. But rates are now 7.5%. And as I laid out, the market for existing homes is completely locked up. It's frozen. I mean, I don't mean like it's 100% done, but like the volume level is anemic. Talk to any of your friends who are in the real estate business, they're realtors, they're mortgage brokers. They're like, oh my God, things are terrible. Things are terrible. So one of the things that's going on that you might not know is that the new home builders, they're like, okay, well, what will get people to buy? Well, they do mortgage buy downs, they de-amenitize. In other words, yeah, I mean, beautiful granite countertops are gone, and smaller lot sizes, smaller homes, and they're selling homes, so they're kind of like taking market share. But there is some amount of pressure in some places where the new home builders have like a dominant position. They can push prices down because any existing home seller has to go. Well, this is all sort of like just like background information. But what's the new politics that I was talking about? Well, it's not Republican versus Democrat. It really has to do with the fact that in local economies, home builders, mortgage bankers, realtors, I mean, they're important to even local politics, right? I mean, and they have the year of politicians, and they're not happy. Right. And people's like, well, so what? And, and there's also been like some reforms around, I think, like who can show a house, and they got to sign things. In other words, things are bad. Right. But these folks, they're important because like housing and shelter is a critical part of human life. And it's a critical part of most local economies. And so there is definitely stuff going on, so President Biden, congressmen, senators, local legislators in your state, mayors, everyone is like being told like, hey, something needs to be done. Something needs to be done. It doesn't look like the Federal Reserve plans to cut interest rates like, tomorrow or next week. So there's pressure on these folks to do something. In the meantime, there's also another thing that's going on that is less understood and less talked about, that is in some ways a more imminent catalyst for these stocks, right? So when the 2008 global financial crisis happened and Fannie Mae and Freddie Mac were tossed into conservatorship, they were kind of like, they passed legislation that said, well, you can't do all these things that you used to do, because one of the things that Fannie Mae and Freddie Mac used to do is they used to be the buyer of last resort for mortgage-backed bonds. For those folks who don't know, every time you get a mortgage, the person who originates the mortgage sells it to one of these companies, Freddie Mac and Fannie Mae, and they pool all these mortgages together and they turn it into bonds, and then they're sold to investors around the world. Well, there are times when investors around the world panic about interest rates, panic about housing, panic about the markets. In other words, our demand for any stock, any investment, any security falls and rises with our confidence. And so you often need somebody that's going to be there as the buyer of last resort. And it used to be Fannie Mae and Freddie Mac. But once the 2008 global financial crisis happened and they were put into conservatorship, the government said, you cannot do that anymore. So, of course, to avoid the housing market getting destroyed, who stepped in? The Federal Reserve. And they started to buy, hundreds and hundreds of billions of dollars of mortgage-backed securities to keep the housing market going. Because remember, What happens when you get a mortgage, whether it be your local mortgage broker, maybe your bank, they give you money, you buy the house, that mortgage gets sold. And if it doesn't get sold, there's not new money coming back into the housing market. So it's an absolutely critical part of the economy because shelter and housing is critical to human life. So, of course, in 2008, what happened? Well, the Federal Reserve stepped in and they started to buy. And you can see in this chart, which I have to thank Wolf Street, which I really recommend if you want free macro analysis, just given away for free, fantastic information, a lot of charts like this. You can see pre-COVID, the Federal Reserve had about a million, 1.7 trillion at the max. And then you can see during COVID, just this rocket higher, right? I mean, enormous amount driven by what? Well, one was the fact that obviously, whatever other buyers that might have been there for mortgage-backed securities right into COVID, does anybody want to own anything? No, everybody wants cash. So the Federal Reserve is forced to buy. And then we have the housing boom, which generates even more mortgage-backed securities. And there's no other real huge buyer. So you can see that gigantic spike up by $1.4 trillion. But now we're in a different place. Now the Federal Reserve is looking to do what's called quantitative tightening. Why? Well, because inflation is no longer, constantly, going between sort of like deflation and marginal inflation. We now have solid inflation. And even after the Federal Reserve has lifted rates by 5%, we still have inflation of 3.5%, maybe even 4%. And so the Federal Reserve wants to make money tighter. What makes money tighter? In other words, suck some of that cash that has been put out there over the last 15 years by the Federal Reserve, wants to take it back in. So they are selling mortgage-backed securities to the tune of $35 billion a year, which means they're no longer buying. And 35 billion. They're selling that. Plus, even with existing home sales being quite weak, there's still some amount of mortgage-backed securities that are being sold. So the biggest buyer is gone. Not only is the biggest buyer gone, they are selling. So with no buyer ready, banks, they are struggling because, they got hit by the Federal Reserve's interest rate hike because they bought long-term bonds. They got huge losses. Insurance companies are in a similar boat. There's simply nobody that is as big or as liquid or as capable as the Federal Reserve that can come in and buy. So, the Federal Reserve has said that they would like to get rid of all of their, 2.3 trillion. They would like to get rid of all of it within, 3, maybe 5, maybe 7 years. Meanwhile, there's new mortgage-backed securities that are being issued and they want to sell 35 and maybe in a few years they'll want to sell 50. So who's going to buy it? Well, if there's no buyer, this is what will happen. This is the key. Mortgage rates will keep drifting higher from where they are today, 7.5% to 8%, then 9%, then 10%, or until they are so high that they are such a good deal that people will sell other stuff or take cash and be like, give me that 10% mortgage-backed security right now. I will take 10%. I will take whatever. But what will happen to the housing market? You don't need genius analysis to imagine. Well, housing prices at 10%, mortgages, they're definitely going to go down from here. Volumes will probably get crushed. Many industries dependent on housing would have a major problem. So chaos, disruption, a market shock. So here's a very long-term chart of the 30-year mortgage rate. So you can see the high point is at 16 something percent in 1981. The low point is under 3% in 2020, 2021. Imagine it at 10%. Housing prices at present are not priced. Many markets are not even priced for 7.5%, which is why you have this logjam. But they're nowhere near ready for 8 or 9 or 10%. I mean, that would be crazy. So this is why realtors, mortgage bankers, home builders, even though they're doing okay, like, no, there needs to be some solution to who is going to take over from the Federal Reserve as buyers of mortgage securities that can, at the very least, maintain the current market. And if the Federal Reserve cuts or there's some sort of economic weakness, and there is more volume of mortgage-backed securities, that there is an institutional buyer in case regular buyers don't show up. And who is the most likely buyer? Well, it's Fannie Mae and Freddie Mac. Why? Well, because they are the only ones that have actually played this role in our economic and financial economy. Nobody else has actively done this. Nobody else has a history, track record, skill set of really all of these troubles and problems and issues and understanding, like, okay, what's going on, and also the scale of it. I mean, we're talking about $2.3 trillion, right? Trillions dollars. This is not something that, like, oh, your local bank or even a fairly large bank like JP Morgan or somebody can just step into. The amount of capital that's going to be required to be the buyer of last resort, to be the liquidity provider for mortgage-backed securities is going to be huge. No one's got that kind of capital today. No one's got that capital today. So who's the most likely player? Well, it has to, in all likelihood, be, in my opinion, it has to go back. They're going to have to throw things back to Fannie Mae and Freddie Mac. But there's only one problem, which is that Fannie Mae and Freddie Mac, after 16 years, are still locked up in this conservatorship from 2008. That conservatorship stops them from being used to unlock any of the problems that, I've laid out for you today. So they can't borrow money. In other words, they can't use their own balance sheet, right? That was like eliminated by law. They're like, no, we don't want you to do that. So if they can't borrow, they're going to need the capital. They're definitely going to have to lever up to do this. Then they also need to staff up. They probably need to hire, hundreds of people. In other words, they need to be run like a private company again. Now, let's look at Fannie Mae. I'm just going to use Fannie Mae as an example, right? Here's Fannie Mae, right? $1.50 stock, a penny stock, right? A penny stock with a market capitalization of $1.74 billion. Now, many people say, well, Paul, 1.7 is a lot of money, 1.7 billion. Listen, folks, this is like a little smidge of a little ant. Yeah, this is like the little tiniest piece of I don't know, what's the smallest part of an ant? Yeah, that's what 1.7 is. Because let me just, also show you how big the business of Fannie Mae is, right? Okay. This is Fannie Mae in its last quarter, right? They had just net interest income of $7 billion. That's one quarter, $7 billion. Yeah. Which are their revenues, right? They had net income of 4.3 billion, 4.3 billion, right? That's just for one quarter. Their net worth is 82 billion with a B, 82 billion, right? They are absolutely crushing it in terms of their business, right? And the federal government needs Fannie Mae and Freddie Mac to kind of come back and play the same role that it used to. These companies, as I laid out in my ex-post, they are in rude health. Their credit is pristine because why? They haven't been allowed to borrow money for 16 years. but they need a clean release from conservatorship. They kind of need to undo what they did, which was, a series of transactions. There was a preferred that was taken, and then there was the net worth sweep, which, has never been officially kind of reversed. I mean, they said you don't have to do it, but everything kind of more or less sits kind of where it is. And in my opinion and in my judgment, yeah, things can't stand, right? I mean, as they are. Let's just look at a chart of Fannie Mae and Freddie Mac. Oh, sorry, of Fannie Mae. Right, this is the chart. This is the 1-year chart. I'll make it bigger. Yeah, I'll make it bigger so you can see that. Is that better? Let me see. I think, yeah, it should be slightly better. You can see it's, about tripled since the bottom in June. In June of 2023. And since then, me and other Fannie Mae and Freddie Mac watchers have just what's going on? What's going on? And if you go on X, you go on Reddit, people are like, oh, this court judgment, there have been some small court judgments that have definitely been favorable, but there's nothing that said hey, the government is wrong, undo this. There's been no big event to just but oftentimes with these kinds of event stocks, I mean, and I just want to, before I go into that, let's look at a 5-year. This is what the 5-year chart of Fannie Mae looks like. And then let's zoom out even more and let's do, this is all the data that you can find, right? So you can see that waterfall decline from 68, right? Is that right? Yeah, from 68 down to 18 cents in 2010 as the government takes over and essentially moves the trading of these stocks. They were like, we don't even want them to trade on a major exchange. They trades on the over-the-counter exchange, which is a liquid. Essentially moves everything off where it's just so difficult. Imagining, I believe, that they were going to come up with new companies to do what Fannie Mae and Freddie Mac did. And the Obama administration put out a number of proposals, none of which went anywhere. They were too disruptive to the market. When Trump was in power, his Treasury Secretary had a plan to release these things that was reversed with Biden. Some people say well, hey, the reason why for the recent rally, and you can kind of see, the recent move from, it's been about 30 cents to about $2, a little under $2 before it started to sell off again. Some people say, well, it's because President Trump is leading in the polls, and he's likely to be the nominee and maybe be the winner. Other folks are talking about court judgments. Other folks are talking about the fact that, well, housing being in a crisis, there's now incentive for both Democrats and Republicans to come in and say, hey, we've got this impasse, this lockup, this logjam happening in the housing market. And whatever relief that can be offered would be great, but it would certainly be terrible for everybody, Republicans, Democrats, Trump, Biden, anybody, if we were to see 9% mortgage rates, 10% mortgage rates. So this is a clear and present danger, in my view, that is an opportunity for Freddie Mac and Fannie Mae, at least for the stocks. In other words, this is the best catalyst and the most realistic catalyst that I have seen in all the time that I have been following these stocks. And I bought into a preferred all the way in 2008, when they first got just demolished. I bought some just as a pure speculation. And then I've continued to, buy some of the preferreds, buy some of the common here and there. But previously, like I said, it was purely that, hey, this went down, this can go back up. But if you've been following things, the sort of scenario that I have laid out, I believe, is the most important and the most sort of realistic. Why? Well, because there's so many people's livelihoods that are threatened. Mortgage bankers, realtors, home builders, politicians. Yeah, I mean, all of them now be like, yeah, 7.5%, 8%. Yeah, our voters would be unhappy. Yeah, I mean, lots of local municipalities. Yeah, I mean, let alone the potential for like a crisis. In other words, these are all the kinds of things that actually make decision makers finally kind of be like, okay, we have to do something. Why? Because we have no choice. And that's where we sit today. So if you were to look at these companies, I mean, I showed you that Fannie Mae, yeah, currently I mean, the part that trades is about 20% of the shares because remember, the government owns 80%. So that's what, about 1.7 billion. Meanwhile, they have a net worth, which is like book value of 82 billion, right? Of 82 billion. What would this company be worth if it were valued and traded like a regular private company? Like there are like, smaller companies like Radian and others that are sort of like, related businesses. Well, I mean, they trade, either for some multiple of their earnings, some multiple of their sales. In good times, they trade for, maybe 2 times book value. It all depends a little bit on the sentiment, but still, I mean, 82 billion for the entire company, 1.7 billion. But then there's also the terms under which these get released. Whatever it is, it's definitely a lot higher than $1.50. Is it 10 times higher? Is it 20 times higher? Is it 30 times higher? Well, I mean, you'd have to give, lower probabilities to each one. But I would say for a company that is generating what? Let me just go back and see what it's generating. $7 billion worth of of revenue per quarter. So that's $28 billion. $28 billion. Yeah. Right. This is a very, very, very undervalued company if it were to be traded and valued and evaluated like JP Morgan, like Bank of America, like Goldman Sachs, like Citibank. In other words, all of those companies, they were all involved in global financial crisis 2008. And go look at those charts. Yeah, I mean, they've all recovered. They're all back to pretty much where they were in 2008. The only 2 real exceptions in terms of stocks are Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac. So, I mean, put this chart back up again. Let's see if I make it bigger. I'm trying to get this back up. Oh, yeah. There it is, 68 to 30 cents. Could it go back to 68? Well, I've speculated in YouTube videos that we could have a reverse waterfall. In other words, why? Well, the government says, well, we kind of need these companies to go back and do what they continue to do. We have not been able to formulate an alternative. They have the expertise, they have the skill set. We need to give them back control of these companies and allow the managements to run it for the benefit of obviously the shareholders and also to serve a particular purpose. They can't take as much risk as they were taking, say, in 2007, but they need more freedom. They need to be able to play a certain role. And with that, for sure, some part of that waterfall decline in 2008, in my judgment, in my opinion, would get reversed. And which is why in my ex post, I say that these investments offer some of the best speculation opportunities for spectacular, rapid gains in sudden, shocking, and surprising fashion. And with that, I am going to do questions, whether it be about Fannie Mae or Freddie Mac or anything else that you want to put. So let me go to the comments here. All right. We got a regular here, Anthony. Thank you for always attending live streams. Anthony says, Paul, my son said he saw someone with a Strong Hands t-shirt at Target. He recognized because I wear mine all the time. It's a bit tattered, but helps me stay positive in scary times. Thank you for putting that up. Strong Hands, indeed. Another one, also regarding options in your podcast. I'm one of those people in selling options for years. Not borrowing money or quitting my job, though. I really recommend you listen to my Bald Man Speculating podcast on Spotify. Well, I mean, there's a lot of risk taking that is going on because the very big stocks in the market have been rising consistently for 3 years. Many people think that this is a fact of life and that there can be no reversals. And so in the Ballman Speculating podcast, I go into this issue. Check it out. Rashad says, safe travels. Appreciate your good wishes. We got a victory sign here. Thank you for commentary. Maybe I'll come back. Well, the gold is highly revered in India, so you never know. Alex says, say hello to India. I will say hello to India and to my mom. Rashad asks questions. What do you think about the SEC notice to Robinhood? Should we be concerned? Yeah, there's SEC notices given to pretty much all of our companies. I mean, Coinbase has one. Robinhood has one. Various companies have gotten them at various periods of time. I mean, in 2009, pretty much every bank had them. It didn't really change a whole lot. So this is sort of like cost of doing business, a way of how, the SEC is choosing to operate. Instead of like providing guidelines to fintech companies, they're choosing to make their life difficult. In my opinion, it doesn't mean anything. Thoughts on Carvana? Well, I mean, it's rocketed up, so everybody's going to want to buy it. At low prices, no one would have wanted to buy it. I put out my video on it being the comeback stock of 2023. I was kidding around with Dean and Dan. That is also the comeback stock of 2024. In that video, I laid out potential upside of 3,000%, which from what? $3 or $4 would make it what, like, a $300 or $400 stock. So, in success mode, it is still the only true company that has been able to deliver used cars at scale. There is no competition, in my judgment, in my opinion. People can point to CarMax, AutoNation. I've never seen a company be good at two things. Those companies have retail outlets. That's how they sell. That's how they prefer to sell. That's how they make their money, and they're optimized for it. Carvana is all online. And they have dealt with their debt, which was their biggest issue. And there's a gigantic short position, and people hate it. And generally, when people feel emotion towards a stock, generally they tend to do silly things. So if you hate something, you will short it, and you'll often short it with leverage. And that often drives even greater upside. So I'm still bullish on Carvana. It's still in our gold portfolio. I think our gains are up to 600 or 700. I think, no, we have it at much higher cost than when I made the video. So 300 or 400%. And we are going to continue to keep owning it. Squatter laws. I'm not sure what the question is. I mean, the squatter issue is an issue in some municipalities and localities. But I mean, I don't know if it's like so widespread. I believe it's something that is quite specific to certain places where there is a certain sympathy for folks doing that. And so this is something that is very much local. I doubt that this is anything that the federal government or you're going to have on a national basis. Julie says, Biden definitely screwed things. Trump will get things back in order for Fannie Mae and Freddie Mac for sure. They need to be private companies. Yeah, but I can tell you that when people's livelihoods are in jeopardy, and especially when the politicians, when they might not get reelected, because I mean, imagine if mortgage rates went to 8.5% and then 9%, the impact would be huge on housing prices. The impact would be huge on local economies, and that would definitely drive people to express their unhappiness at the polls. So that is the critical factor. In other words, people generally act when there is some sort of pressure on them to do so, and this would these two would be sort of like secret beneficiaries, just like they got hit when there was a very different crisis. They would benefit in with the potential for a completely sort of like alternate crisis of a kind. More comments from Julie, very undervalued. What is your favorite meme coin for this cycle besides Dogecoin? Yeah, I mean, my general view of markets is that you want to generally focus on the highest probability of making money in any investment category, and that's generally going to be one of the leaders. So meme coins, I mean, the leader is Dogecoin. Arguably, the second would be Shiba Inu. But I'd rather, especially in a speculative class like meme coins, where the purpose behind a meme coin that I can only see at present is for it being sort of a medium of exchange. As I've said, like, why would I want to sell my Bitcoin and trade it for something? Bitcoin has accelerating scarcity for the foreseeable future. Meme coins can be issued at will, no different than fiat. So that's the primary purpose. How many meme coins can support a medium of exchange sort of like structure or platform? I doubt that, that like they can all hold their value. So for me, we have the leader, the original, with his Dogecoin, which is in our silver tier portfolio. And that's the one I'm focused on. Everything else would be highly speculative. And, it was not something that we have chosen to focus on in terms of what we are doing in ATG digital portfolios. Carvana is a sponsor for pickleball. Yeah, I mean, that's definitely been good. I definitely see on YouTube some of the pickleball competitions that they sponsor. Don says, what do you know about XRP? Will it become CBDS of choice, or is this all talk? So XRP is in our silver tier portfolio. I personally own XRP and have done so for 3-4 years. My view is that this is a purpose-built blockchain for a very particular purpose, and that is for very fast money transfer. And that is its express purpose. So them getting into the stablecoin business, which they have announced, is a very good idea. My view is that, it's going to take over the transfer business, which is currently, Western Union somehow still, with incredibly high fees and things like that, still generates millions of dollars. TransferWise, which is an app, does the same thing. XRP can do that cheaper, faster, and much more globally. And so this is my viewpoint on XRP, which is it is a purpose-built blockchain for moving money very efficiently, very securely, and very cheaply. And that is the basis really of its value, in my judgment, in my opinion. Julie says, I have an ARM. It went from 2 to 7. Whoa, that's insane. Wow. Yeah, I mean, that's what I'm talking about. I mean, there's also been a number of articles going back to the Fannie Mae, Freddie Mac thing about how people are being forced into ARMs, and where the market share is going up. And so the Federal Reserve wants to dump mortgage-backed securities. That is only going to move any adjustable rate mortgage. They'll reset at higher rates, which again has the impact of essentially, pushing prices lower because people can afford less, all these things. So there are any number of critical catalysts today that says this finally could be the time when Fannie Mae and Freddie Mac finally sort of arrive at what I've been hoping for a long time. But either way, something in my judgment has to happen because you've got too many things going on, whether it be politics, whether it be court judgments, whether it be yeah, what I laid out, which is the impact on the housing market, which I think is the most rational, most logical, most reasonable thing to make people be like, okay, we cannot just keep doing this all at once. We got to like move. Final comment from Julie on Doge. When Elon accepts it on X, well, Elon, Elon was a buyer of Doge when it was, I mean, when it had like 4 or 5 like zeros in front of it. So, I mean, Elon must have, I don't know, hundreds of millions, a billion in Doge. So there's every reason to think that he could implement it as the currency, as the medium of exchange on X, maybe for content creators. Hey, I'll take Doge. I'm good. I'm okay with Doge. You can give it to me. I mean, I'm pretty sure once that happens, any number of other people will start accepting Doge. And now you have really like an economy going in Doge. And so, what other meme coins have the potential for that? Very, very few others. I mean, there might be one or two, but still, I would expect that the biggest one will get the most money. That's how all markets are set up, which is that, the top 5 or 10 pretty much capture most of the market share, and everything else is much less. All right. Thank you all for attending this Monday special live stream. I hope all of you found this useful on Fannie Mae and Freddie Mac, two secret stocks to benefit from the housing crisis. Check out my post on X. And then also, I have written on a biotech company that really looks like incredible, ready to explode higher in the Substack today. So check that out today. And I will be back next week. We'll do the live stream on Wednesday because I get back on Tuesday afternoon. And so I'll do it on Wednesday. So come back. Thank you all for attending. This is Paul saying thank you. Please consider subscribing to ATG Digital Media. And with that, I want to say goodbye.